Hi, Sven Robertson here from Haven Property with your latest property market update. I'd just like to take a moment to have a bit of a chat to you about what I am seeing in the real world that is kind of manifesting itself in these figures. Firstly, the supply side remains exceptionally tight. The developer supply pipeline has been kinked, to put it nicely, because of construction costs which are showing no signs of coming down anytime soon. Mainly because of the price of concrete and steel, which is in high demand across several industries, including government infrastructure works. The AUKUS Treaty in Garden Island and Henderson is an enormous project. Plus we've got the third runway and the roadworks, which I'm sure you've seen everywhere you go, means that these fundamental building materials are remaining exceptionally sought after, and apartment building is just one of those demand factors. Labour is also in fairly short supply because the cost matrix, if you like, of the mining companies and government can simply just pay more than is tolerable by the residential construction industry. What does that mean? That means that well-presented, well-positioned second-hand apartments are really holding their value and increasing in price, a little bit like we saw, for example, second-hand cars during the pandemic. With a lack of supply, it means that people have to go somewhere, and the existing stock is therefore, especially if it's sort of say 5 to 10 years old, well presented with a modern level of specification, is really punching above its weight and showing some really good capital growth. The demand side is also equally robust, which is why I don't see that prices are going to come anywhere down anytime soon. But let's talk about price growth for a second. The price growth that we've experienced in the last 2 to 3 years, like strong double-digit growth, is unlikely to persist in the future. That is because we are starting to bounce against affordability constraints. And what that means is that once we get through about 40% of take-home pay being spent on mortgages and rent, whilst the overall market dynamics don't sort of give me any real belief that there's going to be meaningful downside, it means that where does it go up from here? How do people, whilst buy it off you, once you get to 50-60%, people, those real life affordabilities just don't work. So whilst I think that price growth will remain, it will be more measured than what we've seen. So whilst prices are slowing down, they're not going down. And actually, in many ways, this is a really positive thing and something that we really want to see, because slow and steady growth is sustainable in the longer term. Boom cycles and it leads to bust cycles. Big parties, big hangovers. So I actually think we're actually transitioning into a more measured and sustainable model and market into the future, and I think that's encouraging. If you'd like to reach out and have a chat about your own personal circumstances, I'd welcome the opportunity to talk to you guys. Feel free to reach out, and I look forward to keeping you updated. Thank you very much.